Hello and welcome back to the ROI channel. Having gone through the portfolio structure in the previous video, if you haven't seen that, please go and check it out. It will make a lot more sense. Today we're going to go through not an in-depth analysis, a medium-depth analysis for time's sake. I've already gone through an in-depth analysis on every position in the portfolio, but I'm just pulling apart the most important bits to show you what sort of things we look for when judging certain companies out there and whether or not they are investment grade and can take a position in the portfolio. So for time's sake, I haven't gone through and shown you exactly where I've got everything and the ins and outs of it, but the most pertinent information will be put forth and show you why Allstate is a key holding in the Crassus Investments Funds. So before we begin, if you'd be kind enough to like, share and subscribe to the channel, I would greatly appreciate that. It helps me reach more views and potential investors. So if you do find value in the content, I would very much appreciate that. If you are not familiar with eToro, by all means check it out, do a bit of reading. Great platform. You can download it to your phone, and if you're interested in copying the portfolio, then there'll be a link at in the description and at the end of the video. So let's get into it. Allstate, if you're one of my fellow Australians, you've probably never heard of this company. Trades on the New York Stock Exchange. It's one of the biggest insurance companies in America, under the ticker ALL, as you can see there. And it has a great track record, and it is criminally undervalued and underappreciated. I think that's my belief. See the disclaimer at the end. Obviously, this whole channel's my opinion, but as we'll start to go into it, I think you'll realize that Allstate's not getting a lot of love because it's a boring company, and boring companies often make for the best investments. Quick a rehash of our investment framework that we use. Obviously, we want companies with low debt and a high margin of safety, sales growth, but strong margins. Okay, so some tech companies go a little crazy with the revenue growth and attract massive multiples, but they're actually not making any profit for shareholders and investors. We want free cash flow growth, so we want that growth to be able to be distributed to the equity holders at the discretion of the company, high returns on invested capital, and a history of share buybacks. So those are the things. If we can get those things lined up, chances at a reasonable price, chances are we're going to do fairly well. Some quick facts about the company. Again, I've just tried to put this down into a nice, neat little snippet. Their revenue this is in millions of US dollars, so $41.65 billion of revenue. Over the past decade, they've been able to grow that revenue at a compounded annual growth rate of nearly 4.5%. Okay, so for a company that size in insurance, that's decent. Okay. It's not, being an insurance company is a little different. It doesn't report EBITDA, okay, so it reports operating income. We'll call it EBIT, 5.3 billion, so decent margins there. They've been growing. Shares outstanding at time of recording, 299 and a bit million. And return on capital, very, very healthy return on capital, guys, at 29.4%. So historically, the management has done the right thing by shareholders for this company, and they've performed quite well. Its market cap, if you don't know what market cap is, it's just the number of shares outstanding times by the share price, okay? Oftentimes, for different enterprises, we'll use enterprise value to EBITDA, but we'll leave that for another video. Price as of recording is 124 and a bit, okay? Now, short-term forecasts. I normally don't do short-term forecasts, but being the first video that I've gone, I want you guys to see where I'm heading with this and to give a quick overview. The forecast looking what is about 18 months out, this company reports, it's reporting 31st of December every year, so about roughly 18 months out. This is what is being projected by the analysts, okay? So we're looking at 284 million shares outstanding if the company were to keep up its historical rate of share repurchases. And remember, if we're business owners and our fellow shareholders are shrinking over time due to the company generating enough free cash flow to be able to buy back their shares on the open market, what that means is our claim then on the rest of the earnings or the cash flows moving forward increases ipso facto. Okay, so purely for the fact that the number of our fellow business partners are shrinking because the company's buying them out and we're holding on to our equity, that equity has a larger claim on the future cash flows. Okay, you've also got to step back and think about this logically. If a company is buying back its shares on the open market, what does that tell you? It tells you that the management thinks the current share price is undervalued. Okay, so if I switch over to this little tab here, this is the history of buybacks for this company. Okay, so look how many millions of shares every year and every quarter that this company is buying back. Okay, historically speaking, it's a phenomenal amount. So it works out to be roughly about 5% per year over the long term. So if we look forward to 2022 and just say, okay, well, what if they take off 5% of the outstanding shares? Where would that be? This is where we're at. What is their projected operating income, okay, or EBIT, and what are their free cash flows and earnings forecast to be? Okay. Again, oftentimes we will use EBITDA, but for this case, we'll combine our free cash flow forecast and earnings. Earnings take into account a lot more of items below the line, as they say in finance. So depreciation, amortization, interest costs, and so on and so forth. That's why you'll often see the earnings understate the true cash flows of the business, whereas free cash flows simply calculated as the cash flows from operation. Okay, so the sales receipts, we would say receipts from customers in Australia, minus operational expenses, minus capex, and minus taxes. Okay, so you're selling stuff. What does it cost you to sell the stuff? You pay your taxes, and then what does it cost you to reinvest in the business? That's your free cash flow. Okay, all the cash that can be distributed out to shareholders, and that's what we're interested in because that's potentially going to be us. Some key metrics. I've gone through these. I've just added in here some key figures. So if you look at the free cash flows projected for 2022. And you divide it back to the current market cap or the share price, that gives us a yield of 25%. So when I'm doing a quick and dirty analysis, as they say in investment banking, I'm looking, okay, how much cash can it produce? What's it trading for now? And what's that as a percentage yield? And you think to yourself, gee, 25%. Is that good? Is that bad? Depends on the interest rates and the current macroeconomic environment. But in the environment today, you ask yourself, okay, can I get 25% yield anywhere else I park my money? Maybe, maybe not. For me, that makes it certainly a flag that we want to investigate more into this business. What has the cash flow been like historically? Have the management been able to grow it? Is it shrinking? What's going on? Allstate, CAGR, again, so compounded annual growth rate of 16% over the last 5 years. Pretty damn good, okay? That's not bad at all. In my opinion, market cap to free cash flow. This is the multiple which investors have historically been willing to pay for those cash flows, okay? So when brokerage houses and investment banks are looking at different businesses, they'll say, okay, this is producing X amount of cash flows, and given the industry that it's in and given how much we think it can grow and so on and so forth, we're willing to pay either a high multiple or a low multiple. Allstate's in an industry of insurance and finance, and the industry median over the last few years has been a 9 times multiple. So whatever business in that sector is producing a certain amount of cash flow, usually that attracts a 9 times multiple. Okay, so if you've ever been involved in private equity or you bought a private business, oftentimes you'll look at the EBITDA of the enterprise and say, okay, well, that's worth a 2x multiple or a 1x or a 5x, depending on the industry. Earnings are here. Earnings growth rate has been really good, and for an insurance company, and the median PE is here. Now, I'm going to show you where I get not all, but a lot of my information when I'm doing my first pass analysis, when I'm quickly just looking through, and that is on this terminal called Ticker. Absolutely fantastic software, and I'll leave a link in the description so that you can create an account if you wish. Okay, so very, very accurate. I always double check against the 10Ks and the 10Qs, which are the official filings of the companies with the SEC in America. So you can go on the SEC website and go through that, but I don't think you really want to watch me do that. It's pretty boring. So we're here and we're saying, okay, let's look at valuations. And of course, the computer wants to be a little bit slow right when I'm doing a live video. And this is where we can look at it. So here we are, Allstate. What is its current PE? And what is its market cap, capitalization, free cash flows? And then we're looking down here, we can see what the mean is, what the median is. I'll talk about the difference between those two in another video because it's important. The highs and the lows. Okay, so that's where we work out for an industry. Okay, this is roughly how much most people are willing to pay for the cash flows or for the earnings, and that will give us our multiples. Okay, now 2022, we're looking at earnings per share. Again, you can find that here. Okay, so it's got all the financial information of the company. It's not the only place you can look. Okay, Yahoo, Google Finance, Bloomberg. You can go through the financials in many different places. I just find Ticker the easiest. And we're saying, okay, if these are the expected earnings and this is the expected multiple that investors are willing to pay for that earnings, what is the implied price as of December 2022? And how does that relate to the current share price? Is it higher? Is it lower? As it currently stands, we've got roughly a 25% upside if this is true and plays out compared to the current share price. Okay. Now, what about if we use the free cash flow to shareholders valuation? So this is the free cash flows expected. What I've done here is I've haircutted it quite substantially. Now, this represents a massive jump in the cash flows year on year. Okay. There's no reason for me not to expect that the company wouldn't be able to earn $30 of free cash flow per share. But you know me, I'm just being conservative. So what I've done is I've created two scenarios. What if they hit what analysts reasonably expect? And what if they're lagging a bit behind? What is the industry multiple of those free cash flows? And what are the implied prices? And you can see what the upsides would be in those cases. And then I've gone through and I've equally weighted them. Okay, so it's not a weighted average, it's just a plain arithmetic average of those share prices, which gives us $217.86. And where is that compared to today's share price? That implies that we would have a 75% upside. So over 18 months, that's not a bad return, provided we can be confident in our estimates. Okay. Again, I've got a whole process where I go through and I pull the financials apart and run them through all sorts of different models. It's really quite boring. We'll go through them at another time. But here are the most pertinent points. If we look at free cash flows, what I've done is taking their announced and next year's free cash flows, expected free cash flows per share, and I've applied historic and conservative growth rates. Okay, so 16%, as we saw before, is a pretty conservative estimate moving forwards. The company has been able to do that in the past. You don't always want to just project forward a company's history, but with an insurance company, it's fairly safe to do so, because even with all the changes that are likely to happen in 10 years, insurance model will still look like someone paying a premium and then insurance paying out according to claims. Okay, so what I've done over the next 5 years, can they keep their historic growth rate? And then being a bit conservative, we've haircutted it moving forwards. And what would we expect as a multiple? I've said, okay, it's going to be a little bit higher than where it's currently trading at now, but still well within the realms of reasons. Investors are going to pay a 12 times multiple for the free cash flows. Given the quality of the business, that's certainly not a stretch of the imagination. The targeted rate of return, okay, which in this case acts as a discount rate, I've put as 20%, and I know people watching will say that is a crazy high figure. That's a crazy high hurdle rate, but it's my hurdle rate. Okay, so in this case, what I've done is I've said, look, if this company is going to produce these cash flows based on analyst expectations and growth rates, and we're going to have a multiple at 12 at the end of 10 years, At what price or below would I have to buy the shares in order to have a 20% return? Okay, so that's how we can cut to the chase and say, okay, can we get our target rate of 20%? Because that's what we want for the fund, guys. Okay, if we're going to take the risk of entering into the public markets, we want to be handsomely compensated for it. 20% compounded annual growth rate is obviously, well, in my opinion, is really, really good. If you can get better, then by all means, go for it. Now, this table should look familiar if you watched the last video. It was Allstate's numbers that I used. I've run it through my IRR calculator. Again, this is just one of the many scenarios that I run the numbers through. And in this case, I've used more of an academic model of saying, these are the cash flows. This is my entry price. If I were to take all these future cash flows and then discount them back, in this case, using a rate that is the company's cost of capital, okay? What that means is the company has a cost of debt and a cost of equity. When we discount it back, we've got to be getting a return above that cost of capital. Otherwise, it doesn't make sense, okay? The company, if it's not hitting its cost of capital returns, it may as well just pay out its debt, pay out its bond holders, and so forth. So in this case, if we pay this price and we get these cash flows over this time period, discounted at the cost of capital, this is what our IRR is expected to be. Okay, that's the interest rate in our imaginary bank account that we would be getting year on year compounding if we invested at this price, and that imaginary bank account could produce these types of numbers. So then I've done the same thing with the earnings, okay? And we can see no matter which way we dice it, we're above our 20% hurdle rate, if you want to call it that. And that gives us really, it gives us real confidence moving forward to say that this could be a good investment, okay? As always, this is just my ideas and my opinions, so you need to do your own due diligence. Maybe I made a mistake, maybe I'm crazy. These are all the things that you've got to take into account. Okay, some qualitative factors. Remember this little guy here from the last video? That's always what's on my mind and what should be on most investors' minds, if you ask me. If we step out over the risk line, there better be a pot of gold waiting for us, okay? Otherwise, we may as well stay put until one comes along. If we do a very quick and dirty SWOT analysis of the business strengths, it has a huge float, okay? If you're not familiar with the way an insurance company operates, it takes receipts and premiums up front, and it can actually go and invest that money before paying out claims, okay? So they tend to be very conservative and hold a lot of them in liquid instruments like treasury bonds and cash. And in this particular case, Allstate has quite a good distribution. It can meet all its current liabilities that are due within 12 months with cash and cash equivalents on the balance sheet. So huge, huge balance sheet, very strong. And they have some longer term investments in private equity and some more aggressive strategies to be able to actually make a return on the premiums that they receive. It is really, it's cash flowing like a freight train as far as I can see. Does it have sluggish return on capital compared to the weighted average cost of capital? I don't think so. For an insurance company, they have to be conservative in how they invest. If we're getting our return on capital of nearly 30% for an insurance company, I'm happy with that. Opportunities moving forwards, getting into the auto insurance. So people haven't been driving their cars as much due to COVID. United States is ahead of us in terms of vaccine rollouts, etc. So more people are going to be out on the roads. It's a requirement in most states that you have to have auto insurance, and so they have already bought out car insurance companies. And in my opinion, I think that they could continue to do so if management deems it prudent. One thing that people are talking about in terms of threats to the business are bond rates. So if you remember, I talked about the float having lots of short-term treasury instruments. That's kept generally in US T-bills and notes. So if the bond market were to fall out and interest rates were to rise, they would actually invoke a capital loss on those securities. Here's the deal with that. The United States is in so much debt and getting into further deficit every single year. The last thing the US government wants is for interest rates to rise. Okay? They're not going to let it happen. The Federal Reserve is buying up all the bonds, doing whatever it can to keep interest rates low. Okay, so I do not see this as a massive threat. And as I mentioned before, they're not solely invested in treasuries. They also have some other instruments in which they can invest the float. So this is what I'm doing. I've bought Allstate for full disclosure in my personal account and in the eToro fund. And the reasons are quite simple. In my opinion, it has a low debt, it has great margin of safety, it's shown reasonable sales growth for such a big company in its sector, very strong margins and return on capital with great free cash flow growth, and it's involved in share buybacks. So that gives me a lot more confidence in the management team. Thank you for watching. If you're interested in copying the portfolio, by all means, check it out on eToro. You can click on the link that will also be in the description. I'm active on Twitter, or I'm getting more active on Twitter. The ROI channel is my Twitter handle. And please, as I said, like and subscribe to the channel so we can help grow it. If you like the video and you have any suggestions, by all means, please leave comments below, and I'll do my best to alter and tailor the content according to feedback. As always, please see the disclaimer. I'm not your financial advisor. I'm not a financial advisor. Please go through all your due diligence checks as would be sensible when thinking about any form of investment. Other than that, I'm going to leave it there. I hope you have a wonderful day from wherever you are watching, and I'll be back with another in-depth analysis of stocks that we own in the fund.